reaction to the Fed's policy announcement, and I'll try to do a quick summary at the beginning, and then I'll leave it open to questions after I've finished my summary. So I will try to keep it short. I think markets were expecting the Fed to do nothing. It did nothing. I think what's worrying people at this point is that this is a turning point for monetary policy. You have these kind of places where the direction of travel changes when you go from a rate cutting cycle to a rate raising cycle. And the worry, I think, for markets, particularly for growth stocks at the moment in the United States, is that we're about to enter a tightening period. Now, of course, the Fed did not signal that today. That was very clear. They're not saying they're going to tighten policy. They're really saying that they think risks are kind of balanced. So the risk of tightening too much, remaining too, for the stance to remain too tight for too long, is equally balanced with keeping rates too low and letting inflation increase again. So balanced at the moment. The economy's in a good place. That's something that Powell said repeatedly. Inflation is not far from their target, still a little bit too high because they focus on core inflation, of course, because that's a good predictor of future inflation. What people feel is headline inflation, and that's not far off their 2% target. So it's pretty clear they think, they've done a good job getting inflation back down to 2% without causing a recession. They've got a soft landing. But all of the questions today were really about two things. The first one is, does what President Trump thinks or has said about him understanding monetary policy better than you effectively change what you're doing? To which the answer is clearly no. And the other set of questions was about things like tariffs and other policies which are coming in, which will the Fed already start to think about changing its monetary policy, making it more restrictive, potentially, to head off that inflation spike. So, I think that kind of summarizes the kind of flavor of the questions, if you like, about what Trump's policy would be, about what Powell's policy would be today. So let's just quickly go through what the state of the economy is. But also, I think what's interesting is to look at what the markets think about what was going to happen, but also how expectations have radically changed over the course of just a quarter, one quarter of a year. So let's have a quick look at that. Right, so this is, remember that Powell is out, essentially. His term ends in May of next year, and Trump has said he's not going to get rid of him, but they are going to come to loggerheads. I think it's almost inevitable. The policies that Trump has got are inflationary, the mass removal of illegal immigrants who do a lot of very low paid labour generally. They're going to have to be replaced with higher paid workers, which is going to be inflationary. That's one policy. Tariffs also inflationary, certainly over the short term. So I think those are the problems. And Trump is trying to get OPEC to increase production, to drop the price of oil, to somehow soften that inflation blow, which he knows is coming. Almost all of his advisors must be telling him it's coming. Whether he'll succeed with that, we'll have to see. But what worries me is that if they do come to loggerheads, and he's trying to influence Powell and the Fed, that it'll erode people's belief that the central bank is independent. And then the US is skirting with becoming almost like a third world country, like Turkey, where the president basically has crazy ideas and forces it onto the central bank. Markets will not like that. That's the kind of thing which really would cause huge repercussions in the bond market, the US Treasury market. That affects the risk-free rate. It would cause a sell-off in equity, I suspect, and its effects would be global. So let's just hope it doesn't come to that, but I think we're pretty clearly headed in that direction. Policy change, there wasn't one. These are the changes from last time. A lot of people picked up on this sentence. So what's changed here from the previous meeting in December is it says inflation has made progress towards the committee's 2% objective but remains somewhat elevated. They took away the progress section. And he said that was just to tidy up the paragraph. He said it didn't signal anything, but it kind of does, which is that they are now more worried, I think, about inflation, which policy is going to generate. But, you know, he couldn't say that. Recession, yeah, the SARM rule kind of almost kicked off last time. So this looks at the rate of change of unemployment. And that's a fairly good predictor of US inflation. And it was just skirting with this threshold number, if you look at the rate of increase of unemployment. But it didn't quite get there. It just went over a tiny bit and it started to come off. So worries about recession at the moment are kind of non-existent, justifiably. US growth is pretty strong. Now, they didn't change the summary of economic projections, but last time what we saw was that they cut the Federal Open Markets Committee. Their expectation was that we're going to get 2 cuts this year and then 2 cuts in 2026. And then pretty much by the end of 2027, we'd be back to the kind of long-term neutral policy rate. So inflation would have been squashed out of the system. Well, now let's come on to the expectations, because this is what's really interesting. Cast your minds back all the way to September of last year. So that's 4 months ago, right? This is what markets were expecting. 2 jumbo rate cuts, so 50 bips, 50 bips, and then every single meeting there'd be a 25 basis point rate cut, except for one in July of this year, and then another one in September. So that's what people were expecting, aggressive rate cuts throughout the course of this year, such that by the end of the year, September, we'd have been down to about 275 to 300 basis points. So the long-term neutral rate. Inflation would have been crushed. Now let's skip to November. Oh, okay, not so much. And now what we're looking at, certainly on the basis of what I saw this morning, this is what the meeting probability suggested. And the first shocking thing is, oh look, there are actually 2 hikes which are priced in here. Well, the potential for 2 hikes. The probabilities are low. It's at the end of 2026. So this is roughly July to December 2026. Well, the probabilities are non-zero. But now we're talking about rate hikes. And that's a completely different ballpark. So this is what I'm talking about. This could be a turning point in the cycle when we go from rate cuts to a rate hold and then rate increases to fight inflation. Inflation brought about by fiscal policy and by trade policy. Now, that's pretty surprising. Also, they're only expecting a cut in July of this year and then another one in October. So not many cuts at all, and the potential for a rate increase when we get all the way to 2026 around September or October of next year. So that's pretty shocking, I think. It's a big change in expectations and the possibility that this could be a turning point in the cycle. Now, the balance sheet is still shrinking. Yes, it's shrunk by about a quarter now. So we've got quantitative tightening, and we've also got a fairly restrictive monetary policy still, according to the Fed. So now let's turn to the press conference and what was actually said, because that was interesting. Some really interesting questions from the journos this time. They usually ask pretty good questions. Let me just show you one actually from Steve Leisman, because I don't know if I'll be able to play this. I'm going to have a go. Let's see if it works. So Powell finished his kind of standard statement, and then he started to take questions. And the first one was from Steve Leisman, and it got a chuckle from the audience, Powell's response. He tried to ask 3 questions in one go, and Powell kind of balked at that. But you listen to what he said.
Stability goals. Thank you. I look forward to your questions.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a three-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if any, does a president making these kind of remarks have on policy? Thank you.
Three questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact. Thanks.
So I've had no contact. He didn't actually hear anything from the president directly. So is Trump going to try and affect what he does? I think it's certainly on the cards. He's certainly not going to be quiet about his opinions. At Davos, apparently, what Steve Leisman says is that he said he'll demand that interest rates drop immediately. Now, that's not a hands-off president. That is a president that's trying to affect what the central bank is doing. And that's a problem, in my opinion. So that's kind of just storing up problems for later on. So expect fireworks in this relationship between Trump and the central bank. Because usually what happens, well, I think what will probably happen is there'll be economic problems and inflation, and it'll be blamed on the Fed. And Trump will be saying, oh, you should cut interest rates to stimulate the economy. The Fed won't want to because it'll be worried about fighting inflation. And I think that'll be the sticking point. Another interesting thing was about how tariffs would affect things. And immigration. So immigration was a kind of interesting point. Somebody said, last September you said, we understand there's been quite an influx across the borders, and that's actually been one of the things that's allowed the unemployment rate to rise. So more workers, not enough jobs for them. Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react? Now, what Powell said is, yes, flows across the border have decreased very significantly, and he expects that to continue to do so, but job creations come down at the same time, and that's why unemployment hasn't changed. Remember that if unemployment increases a lot, then that kind of does the work of the Fed for it, because it slows down inflation, but that's not what we see. So maybe the initial effect of less immigration and deportations is not going to affect unemployment. The worry is that it's going to affect inflation, of course, as I said earlier. Now, there was another interesting question about AI. Somebody said, I wonder if the AI prompted sell-off in the stock market this week. Of course, this is the story about DeepSeek, the Chinese AI company, which has released an app which does with a fraction of the cost what very expensive models like ChatGPT has done, but with much less resources, much less energy, much less cost. They say it cost about $6 million to train their model, which is far less than it cost to train OpenAI's model. And of course, they had to do it with chips which weren't top-notch from NVIDIA, which also affected NVIDIA's share price. Because if you don't need all that expensive hardware, then maybe there won't be such a big demand for their chips. And what he said on AI, it's a big event in the stock market, and in particular parts of the stock market, NVIDIA, and also other chip manufacturers and energy producers as well were affected. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for some period of time. So he said, I wouldn't put a label on these events, though. of course, we're all watching it with interest. So not really going to affect monetary policy. It's not large enough in its effect or long-lasting enough to really make a big difference. I think the best question today was from a young guy I haven't seen before. And he said, what does your experience about the current uncertainty in the economy, because that's another theme that we saw today, uncertainty. What of your experience will allow you to cope with that uncertainty? And there was a lovely reply from Powell. He said, uncertainty is with us all the time. It's human nature to underestimate how fat the tails are of the distribution. And we're always underestimating the size of those tails. But then what he went on to say was that this is not that kind of uncertainty. He said, if you think about it, about the first few months of the pandemic, that was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. And the other example he gave was the financial crisis. Again, systemic worries about the entire system collapsing. That's uncertainty. What they've got now, he says, is a good labour market. The economy is growing at 2.5%, which is good for a developed market, certainly good for G7. Inflation's come down to a headline number that was 2.6, and that's what the public experiences. They look at core. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But the kind of uncertainty that we have is just the usual level of uncertainty about the economy. So he kind of downplayed the uncertainty that we're currently seeing. But then the policies, Trump, which are, not for us to criticise or praise, really those are the policies which people have been elected to implement. It's what the American people want. They're implementing them with a view to making a better economy. The Fed, of course, and the White House are pulling in the same direction. They're trying to do what's best for America. They may have a different view about the effects of different policies, but effectively they are working towards the same goal, which is American growth, maximum employment. And I thought that was a great answer. I just thought that was great. So let me stop there, and we'll throw it over to questions. I'll also summon my cockapoo upstairs. Now, somebody complained about this last time, which is not good, because Teddy's a very pivotal part of this channel, my life, and a friend of everyone who watches. So hopefully he'll come up and have some treats, and then he'll pop back down for Biltong while you think about questions. So please do ask a question. Please do like. Please do share this live stream. Okay, and we've already had a super chat from Rajasilan Ganaswaran, who says, a subs Teddy for our favourite cockapoo. Here he is, star of the show. All right, Ted. So I've saved you some of your stinky treats, the buffalo ones, and you have to demonstrate your standing up while people think of questions to ask. There we go. Now you could rest on my knee, or you could stand properly. Come on. Oh, Teddy, you're so good. Well done. You're going to come over here. That's it. Good boy. You stand. Stand. Oh, good boy. One more. One more. Oh, beautiful. Oh, you're so clever. Well done. Now he's listening for the Laura Biltong rattle. I don't know if she's got any left. Laura's been dipping into his supply. She's very keen on the biltong as well. I did get a huge amount from the shop recently. I bought my son a 2.5 kilogram biltong cake for his birthday. He loved it. There he goes. Brilliant. So yes, if you have any questions, please do a super chat. It helps us, obviously. Like and subscribe. That helps us too. And yeah, I'll switch over to the questions. Thank you, Rajasilan. I really appreciate that. And Teddy obviously appreciates it too. What have we got? Hello, Teddy from Lawrence Hooper. There we go. It's just Teddy. It's all about Teddy. Here we go. Good question. So there's a question from Rajaseelan. He says, what happens if we invest in a momentum factor ETF in a bear market? Interesting question, because momentum, of course, adjusts to trends. So if you've got a steadily downward trending price for the S&P 500, then not all of the stocks are going down, obviously. Some of them are going down less than others. But if it's a consistent trend and there are particular stocks which are bucking that trend, then the momentum factor will pick up on the ones which aren't falling as much and it'll outperform. If you've got a certain type of stock which is trending upwards, like growth mega cap stocks, like tech stocks, like AI narrative stocks, it picks up on that trend. Now, every 6 months or so, I think, maybe it's quarterly, the momentum, MSCI momentum, I think I was asked this before, so let me get it right this time. How often does the MSCI momentum index rebalance? So let's hope Perplexity gets it right live. Perplexity's great. I love it as a search tool. I hardly use Google now. I use Perplexity for almost everything. Semi-annual basis, typically on the last business day of May and November. These coincide with the May and November semi-annual index reviews of the MSCI Global Investable Market Indices. In addition to the scheduled semi-annual rebalances, the MSCI Momentum Index also undergoes ad hoc rebalancing under certain conditions. And that's to mitigate drawdowns during periods of high market volatility. The trigger for ad hoc rebalancing is checked monthly, except for the months of the scheduled semi-annual reviews. So there you go. So if the monthly change in volatility exceeds a certain threshold, and that's 3-month trailing volatility realized, an ad hoc rebalancing is triggered. So high vol, you're going to rebalance. So that's the really difficult thing for a momentum factor, which is that the trend reversals are when it underperforms. So as long as it's the same types of stocks trending upwards, everything's fine, it'll outperform. Same for trending downwards, it'll outperform a normal market cap weighted benchmark. But it's the turning points that are the problem. And if you're unlucky, then the turnaround will come just after one of these rebalancings. So it won't have time to adjust. It'll have a full 6 months of getting it wrong. So that's the problem. I think the MSCI Momentum Index should probably rebalance more frequently, but the problem with that is that then the transaction costs increase because you're turning over the stocks more rapidly. So that's the trade-off. Rebalance more frequently and pick up changes in direction, and then increase the cost of the fund, which people hate, or just do it every 6 months and make it fairly cheap to track. And that's clearly the way they've decided to go. And there's also a comment. It's worth noting that MSCI is currently considering a proposal to increase the rebalancing frequency of the momentum indices from semi-annual to quarterly. This potential change aims to address the decay of the momentum factor between rebalances while managing the associated turnover, right? So they think they got the balance probably wrong. They're going to do it quarterly, which I think would make sense. Anyway, yeah, interesting. But momentum, remember, does perform pretty well. It is a factor which is very good. Historically, it backtests very well. And a combination of two things, value and momentum, I think is a good combo. So in the UK, I've got a value momentum quality portfolio of stocks, which isn't doing very well, to be fair. But I like that combination of things. Yeah. Oh, and we just reached 200,000 subscribers. I forgot to say, so thank you if you're one of our subscribers. This is my chance to actually say thank you if you are a subscriber and you're not a member of our community. But thank you. I really appreciate it. And it has been difficult to get here. It's been a long time coming. But look, 200,000 subscribers. They don't have a 200,000 subscriber thing You only get one when you go to 1 million. But, we're on the way. Assuming I don't keel over before we get there. So thank you. Thank you for the support. Someone says, looks like a deep fake, Jerome. No, it was a real deal. I'm looking to become a self-taught financial advisor and then maybe practice as an independent financial analyst, FA, financial advisor. Is this a route you would say is possible and a good career move? Well, I think, obviously I'm someone who's worked in investment banks for a long time. So the reason why I thought I could add value is because I know the markets, I know how the players in markets make their money, and I understand the assets themselves, how they're priced, how they're traded, and how things like liquidity affect markets. So all of that was stuff that I learnt when I was a strategist in investment banking. And I taught finance as well for a long time at an investment bank, which was great to learn about all the assets, how they're priced, how they work. I learnt so much, and I worked with such great people. So that's what I think I bring to the table. So if you're going to teach yourself, think about what you could bring to the table. It doesn't have to be technical. It can be about how people psychologically cope with investing. Is it an emotional roller coaster? Yeah. And it's difficult and it's lonely. So I think if you focus on that, for example, it doesn't have to be the technical aspects. Everyone brings something to the table, but you've just got to identify what that is. But if you don't bring anything unique to the table, if you're just going to have opinions, then, I don't think that'll be particularly useful. So maybe it's worth training as a financial advisor. I think it's a useful thing to train in. And I think there are certain regulatory things which you can't do. You can't give advice unless you're authorized. So, it's worthwhile. If you are going to give advice, you have to be authorized. So maybe it's worthwhile getting the training. And it's not that difficult. If you've done a degree, I'm sure you could cope with the financial advisor exams. Or you could do what I do. I'm not a financial advisor. I don't really advise people. I teach people how markets work and then let them decide for themselves. So that's been a very successful business as it turned out. But I didn't know that when I started. What other questions have we got? Not many, to be fair. Well, anyway, we do have another live stream that's going to be later this week on the Bank of England. Let me just pull up the calendar. Yeah, so we've got the Bank of England next week, I think. Yeah, the Bank of England on the 6th, and we'll be doing a YouTube live at 7 p.m. on the 6th of February. So do tune in for that, and hopefully that'll be interesting. The Bank of England obviously is in a very different situation to the Fed because growth is a lot weaker in the UK, and inflation is turning out to be quite sticky there. So, very different story. The Bank of England is much more likely to cut, I think, than the Fed. So we'll just have to see what the policy change is. But of course that creates problems because sterling will probably weaken as a result, which can be a problem for the UK economy. But we'll deal with that on the day of the live stream. So let's see if we've got any other questions. But if we haven't, then... good question. Have you checked out OpenBB? Yeah, I have. It's not bad at all. I don't really need it. I used Coifin for a while, and that was pretty good. I use ShareScope for my data and looking at prices. So that's very good for European funds. So yeah, ShareScope, very good. Microsoft should buy Perplexity. What's your opinion on Microsoft buying TikTok, US? Yeah, I'm not sure that's a very good fit. I think Perplexity buying TikTok made more sense to me because they could then use some of the not particularly useful videos from TikTok as part of their search. I've never found that TikTok was particularly useful. I mean, some of the content's good. I met some TikTok content makers at an awards ceremony with Finfluencer, and they were amazing. You know, I thought they were great, really interesting people who produce great content. So maybe that kind of content could be amplified in Perplexity. But yeah, I wouldn't be surprised if Microsoft buys it and kind of incorporates it into Bing in some way. But I think a better fit would probably be Perplexity. I think that would be a really interesting combo. I love Perplexity. It's really good. Because all of this problem about asking AI stuff is that it just bullshit, you know? It's like talking to someone down the pub. Whereas Perplexity is all referenced and it just simply summarizes reasonably reliable sources on the internet and then synthesizes what those results are in a kind of coherent and compact set of paragraphs which summarizes it. So it's brilliant for research. And then you can drill down into the individual references just to see where it all came from and assess whether you think those are good sources, which I think is the best way to do it. I think that's great. Very useful. So let's... I'm surprised at how well the FTSE 250 has held up. Yeah, it hasn't really sold off much, has it? But look, we've got no tech in the UK. You know, that's always a benefit. During the tech wreck, I remember the FTSE 250 shone, you know, for that brief period when tech was just ploughing into the ground in 2022, the tech wreck. You know, the UK was just completely beautiful at that point. No tech at all, very little in the indices, and it wasn't affected. So maybe we'll have that again. Here we go. Did Laura buy, hold or sell Nvidia during the dip? She held, I think. She's already sold half of her stake, I think, with 100% profit. So from this point on, she's just going to hold it, I think. I don't think she's going to sell, which is interesting. Any thoughts on DeepSeek? Yeah, I've tried it out. It's pretty good. In fact, on Perplexity, let me show you. It's cool. Let me just, yeah. Let me just share this with you. It's pretty good. So this is what Perplexity looks like. Now, you can either have the Pro or not. Obviously, I choose the Pro. But now it's got DeepSeek model hosted in US. So I wonder if we ask it about Taiwan, is Taiwan part of China? Let's see whether being hosted in the US makes a difference. Political and historical perspective, reasoning. Now this is what's different about DeepSeek, which is that it does these kind of fairly elaborate steps of reasoning. The status of Taiwan is a complex geopolitical issue with multiple dimensions. And then it talks about the history. So quite different from the one that you get in China, because lots of people have posted on social media where they show that, you know, essentially is saying that Taiwan is part of China. But this one's much more evenly balanced. So obviously they've trained it differently. So that's interesting. Anyway, yeah, you can get it as part of Perplexity now. So that's kind of cool. I like it. But I kind of signed up for it. I think it's quite interesting. But obviously what it means is actually good for Nvidia, I think. The Nvidia sell-off, I think, was a mistake. I think it was an overreaction, because what this actually means is that you can actually achieve more with DeepSeek with more powerful hardware. It can reason more quickly and it can be trained more quickly. But the fact that you can do it more efficiently, we discussed this on the podcast recently, Many Happy Returns. The fact that it's actually more energy efficient and less costly to train the model with DeepSeek shows that economically these things are more viable. Also, they'll have less impact on the economy because they won't be so energy intensive. So I think it's a win-win. And what it probably means is that Western companies are also now going to make their models more efficient, or try to. And it, in a sense, you can kind of bootstrap off the existing models because you can use those for the supervised learning kind of aspect of the model, where you give it reinforcement signals based on the correct and incorrect answers, and instead of using a human to give those scores, saying whether it's right or wrong, you use an AI to train the other AI, which is pretty cool, I think. So you can bootstrap from one model to another and make it more efficient, the learning that way. So I think people are going to copy what DeepSeek has done, which is actually published. It's published a paper about how it did what it did, which I think is great. It's very open of them, and it allows other companies to do the same thing. So yeah, it's a big step forward, and I think it's good news. And it's good news for AI. It's good news for the long-term prospects of AI, and I don't think it's a big problem for NVIDIA at all. What it really means is that you can do it with less energy. Oh, Laura's answered. I held. There we go. Bright Blue Smurf says, my UK stocks are doing incredibly well since January the 24th. Well done. I feel bullish for 2025. Banks and crews are going to continue making new highs. I've got to say my small cap portfolio is not doing very well at all, unfortunately. When the world population starts to decrease, will markets cease to grow? Would this be the time to sell the trackers? Interesting question, Sasha. I think it depends on consumption. There was an interesting thing from ARC, which said that because we're going to have robots, it's the robots that will start consuming stuff, and we're going to see an exponential increase in consumption, because we'll have sentient robots, sentient AIs, and they'll do the consuming, which is an interesting take. A little bit crazy, which you'd expect from ARC, but interesting nonetheless. But yeah, that's the problem, which is that if population growth stabilizes or starts to tail off, there'll be less people to sell stuff to, and that's going to be bad for profits. It's going to be bad for economic growth. But the thing to remember, and I'm with Elon Musk here, weirdly, which is that if we become an interplanetary species, we're not limited to the resources of one planet, and then you really can start to scale humanity and earnings. So the moment we do become interplanetary, well then all bets are off, right? At that point you can start to scale civilization. So that could remove the cap. It's like taking the cork off a bottle once we become interplanetary in terms of earnings and also population growth. I wonder if I should mention that. It is a bit sciencey. Let me just see if I can find it. Yeah. So there is something called the Kardashev scale. This is very nerdy, I'm sorry. Please don't encourage me. But the idea here is called, here we go, Kardashev scale. A type 1 civilization can access all the energy available on its planet and store it for consumption. Now, we're not quite there yet. We can't control natural events like earthquakes and volcanic eruptions. But we're getting there. We're slowly starting to get there with type 1. Type 2 can consume a star's energy. So you build a sphere around your entire star, capture all of the energy generated by that, and that gives you much more in terms of resources. And you live on the inside of the sphere facing the star and absorb all the energy. And there's a huge amount of energy emitted by a star, of course. And then type 3 civilization can capture all the energy emitted by its galaxy and every object within it, including the black hole at the center. So, we're just starting, is what I think. And so if you're optimistic about society, I think there's a lot more scope for growth, to answer your question. Rather nerdily. There's one super chat here, so I'll answer that and then we'll probably finish because it's 9:30. This is from Philip C, super chat. Thank you very much, Philip. He says, if investor panic causes the FTSE 100 to plummet by 50%, how would this likely affect the dividend yield, assuming company profits remain stable? What you often see let me give you the example which I noticed, which was in 2008, which was Barclays. Now, Barclays was a bank, obviously. It was cyclical. It was massively negatively impacted by the global financial crisis. So the dividends that it was paying up to that point, when you calculate the dividend yield, you look back over the last 12 months. You take the price today, you take that income over the last 12 months and divide by the price today. Now, what happened to the price today was that it fell very sharply. But of course, the trailing 12-month dividends didn't. So you've got a big number, relatively, divided by a very small number. So the dividend yield went through the roof. Now, that's a sign that the company's in trouble, of course, but dividend yields can increase for bad reasons as well. Not because the dividends increased, but because the price has fallen sharply. So the initial effect would be that dividend yields would surge. But it's a false signal, because in that kind of environment where the stock prices are tanking, it's because there are economic problems and there are problems with that company. That's why the price is falling. So that at that point, the board will probably decide to cut further dividends so the company survives through the crisis. So that's the problem. Don't be kind of sucked in by the fact dividend yields have surged. It's just a sign that there's going to be trouble ahead. That's the worry. Now, another kind of crisis is one in which, say, for example, there's a credit crisis. High yield ETFs, high yield corporate bond ETFs, the yield on those also increases for the same reason. The price of the bonds has fallen. The coupons continue to be high for a while. And then we get the defaults. And the defaults eat away at your capital. So there, the problem is that if you own them before the crisis happens, you make a capital loss because the spread you earn doesn't compensate for the losses of the defaults. The time to buy, of course, is when the dividend yield is high at the kind of crisis point. Then if you buy, what happens is the bond market prices recover and the income starts to recover. The defaults start to slow down and you get a very good risk-adjusted return. So with all these things, it's always worthwhile not owning it going into the crisis, but owning it coming out of the crisis, if you can. And make sure it's a crisis which is reversible. Remember, some of them aren't, okay? You don't want an irreversible crisis where the price doesn't recover. And of course, with single stocks, that's always a risk. So it's best to have an index which is diversified in high-yield credit or in equity, which is high dividend. Brilliant. Okay. Anyway, I think we'll probably put a line under it there. Thank you so much for joining us, and I hope it was interesting about the Fed not doing anything, but I think the reasons why it didn't do anything are always interesting, and also the responses of Powell to what Trump says, very interesting, but not surprising. Let's just hope that Trump doesn't try to affect what the Fed does, because I think that would be a real problem for all of us. Anyway, thank you for joining us. Remember to like and subscribe. Remember, we've got a community where you can have chats like this, and we've got a chat application where you can ask questions whenever you want. I answer, the community answers. We have over 1,000 people. We're growing, and it's quite lively, and lots of interesting discussions. Like-minded people, I'd say, long-term investment horizons, index investing, but we also have some people who invest in crypto, for example, which is always interesting. So do think about that. And of course, I do one-to-one coaching. So membership, go to pensioncraft.com/membership. Coaching, go to pensioncraft.com/coaching. And thank you for joining us. Thank you.